One such hedge fund which was created, which was known at the time as long-term capital management. They were a hedge fund that was founded in 1994 by a huge bond trader by the name of John Merriweather. He used to work with Salomon Brothers. But more importantly, John Merriweather, Mr. Merriweather, was successful in bringing on two people who were known for their Nobel Prize in economics, Myron Scholes and Robert Merton. If many of you are familiar who've traded options know of the Black-Scholes model, this is the gentleman Myron Scholes and Robert Merton, who won that prize and gave credit to Mr. Black, who had laid the foundation for their work. These three guys, along with some others, put together this hedge fund and created a star quality, a star appeal that attracted a lot of investments from huge banks to large hedge funds and to many institutional investors. And when they brought in this money, many people treated them not like a hedge fund, but more like a bank. Many major banks and large banks around the world felt that with the high level of pedigree that was sitting on the board of LTCM, that this company could do no wrong. As we see, and as we'll talk about in a second, this was a very wrong assessment on their part. Now, LTCM had a very simple strategy. It wasn't complicated, and it wasn't that convoluted at all. We talked about, in the futures and trading traditional commodities seminar, we talked about convergence. We talked about how when futures prices and cash prices get closer and closer to meeting at the exact same date, the prices start to get closer and closer to one another. Just basic converging. Well, LTCM used an example of convergence trading strategy. It was very simple. They would trade U.S., Japanese, and European sovereign bonds on a convergence basis. They felt that over time, particular bonds, especially long-term bonds, 30 years, 15 years or more, that over time, these bonds would converge to reach the exact same yield. So if there was a value of 5% return on one bond and 3% return on another long-term bond, eventually, as these bonds traded over time, they would reach the exact same yield of maybe 3% or 4.5%. And that there were profits between the two different yields. So when one bond was issued, long-term bond was issued, they would buy it or sell it, and then when another long-term bond was issued from another country, they would buy it or sell it counter to the previous bond and let the two bonds converge in value until they reach the same price, and that they themselves at LTCM would gain that 1.5% profit, if it's the difference between 4 and 5.5% for themselves. Very, very simple idea that had a lot of merit. They ran business models, they ran concepts, and they felt that it would be successful. But the only problem with a strategy like that is that there really are no profits in it. For small traders like yourself and I, there's no profit in looking for maybe a 0.2 basis move difference to match up, or a 0.5 basis move profit to match up, because it may only be worth $50 or $60, or even if it was worth $100 on a $25,000 account. It just is not a significant enough move. And LTCM had a unique problem. They had raised over $4.6 billion from various groups in order to create their hedge fund. And they needed to, in order to make their idea work and to create profits, they needed to leverage that into a larger amount in order to succeed and do the returns they were hoping for. So they worked the business models, and they figured that if they used that $4.6 billion to acquire assets on leverage, these bonds that they were getting, that they would be more than successful in getting a return. So they took their $4.6 billion and leveraged it to over $124.5 billion worth of assets. Huge amount of leverage. But they didn't stop there. If many of you remember the collapse of Enron, one of the core problems with Enron was not their derivatives market that was exchange traded. It was the number of private offshore limited partnerships and offshore holdings that they had, in which they were dumping their losses in or doing derivatives transactions that were off the beaten path to their other trading, which exacerbated their problem. Well, LTCM was pre-Enron, and that's exactly what they were doing. They had created themselves a situation where they had contracted with multiple banks around the world in an OTC market, an over-the-counter market, various derivatives, which leveraged even more so their $4.6 billion hedge fund into $1.25 trillion. I said that, I can say that again, $1.25 trillion. Here was an independent investment firm with a huge amount of leverage, larger than many small countries, of $1.25 trillion. And this is the only way that they can make their sovereign bond convergence trading be successful, this amount of leverage. It's mind-boggling. So in the beginning of their program's success, they did great. You know, they had a 36% year on $4.6 billion. They had another 40% year on their $4.6 billion initial investment. And then a snag came in. They didn't take into account that people would sell many of these foreign bonds overseas and begin to buy up U.S. Treasury bonds, thereby driving the difference between the value difference between the two bonds further apart, as opposed to allowing them to narrow together. How they didn't see the scenario is almost impossible for anyone who's familiar with trading. Is just impossible that they couldn't see that this was a potential. But they didn't. And not only did they not see this potential, but it goes back to some of the basics that I've talked about in the past about trading and following basic rules. They didn't cut their losses. They decided to hold on to these positions, hoping that eventually the spread that was expanding would narrow down. Well, it got to the point that their entire investment of $4.6 billion was down over $1.8 billion in capital. Very huge drop. You know, 1/4 or a quarter of their entire hedge fund portfolio. Now, if many of you who've either invested in hedge funds or know about CTA programs may realize most hedge funds close down when they're at a 50% level of losing money. And with the shenanigans going on with LTCM so highly leveraged and losing money, it was only a matter of time for them to continue to lose money and lose their entire investment. But it didn't happen. And the reason it didn't happen was the Federal Reserve Bank of New York stepped in. They realized that if they were to allow LTCM to collapse the way it was going, then there would be a domino effect that would hurt economies around the world. Imagine this. If LTCM collapses with their $4.6 billion of their investors' money disappearing, then you see that there's $125 to $129 billion in bonds which need to be liquidated, and they have to sell those off, which then affects all of the over-the-counter derivatives that LTCM had set up of $1.25 trillion, which all had to be liquidated. You could have a huge banking crisis on your hand that would literally be worse than anything anyone had ever seen. A loss of $1.25 trillion is nothing to sneeze at, especially when you're talking about the investment markets, and especially at this time, currencies and how bonds were affected. So the Federal Reserve Bank of New York steps in and brokers a deal with the top banks that OTC is involved with, and helps them raise about $360 million in order to stay afloat.